Okay, this video is on accounting for capital leases from the lessee standpoint, and in particular this is accounting for, in effect, the initial measurement of a lessee's capital lease. So before we go on and get into accounting for capital leases, I think it behooves us to spend just a few minutes and review uh, the components that would be part of a minimum lease payments for a lessee. Again, it's really important that we understand these components. So let's start out with the first component of a minimum lease payment, and it's called the minimum rental payments. And these are the minimum periodic rental payments that are owed by the lessee, and that's from inception all the way to the end of the lease. Now, the one thing we have to remember is that executory costs are excluded from the minimum rental payments. And executory costs include the cost of things like insurance, maintenance, and tax expense related to a leased asset. Another component, or the second component of minimum lease payments, would be a bargain purchase option, or BPO. And this gives the lessee the right to purchase the leased asset at a price significantly below the leased asset's value at the date that the BPO becomes exercisable. In other words, it's a deal that you really can't pass up as a lessee. That would be a bargain purchase option, or BPO. There's also another item called, or another component of minimum lease payments called guaranteed residual value. And this is where the lessee guarantees all or part of the fair value of the leased property to the lessor at the end of the lease. A good example of that would be where the lessor, or rather the lessee, guarantees the value of an asset when it's being returned to the lessor. Its value is going to be $10,000, and that's written into the lease. However, when the lessee turns that asset into the lessor, it's only worth $6,000. At that point, then the lessee would be on the hook, or in effect would owe the lessor an additional $4,000 for the portion between the fair market values as it was turned in versus what was guaranteed. Now, one other thing that we need to be cognizant of, and we've talked about this in our previous videos, if a third party basically guarantees any of a lessee's guaranteed residual value deficiency, the amount that we're talking about, the guaranteed residual value, that amount need not be included as part of the minimum rental payments. The fourth component of a minimum rental payment is what we call a non-renewal penalty, and that's a penalty that is paid if the lessee elects to not renew a lease or extend a lease at the end of the lease period. Now let's take a look at how in the theoretical view of how the lessee actually calculates their initial lease liability. So again, when we record our initial lease liability, the debit is going to be to a leased asset, because we're treating this lease as if we're actually purchasing the property. So we have now a leased asset as a part of the purchased property. We also are going to credit a liability, lease liability, and both the asset and liability will appear on the balance sheet. Now, the initial lease liability is going to be computed as the present value of our minimum lease payments, and that is going to equal, number one, the present value of our minimum rental payments, which we talked about from the previous slide, and that's going to be excluding executory costs. But when I talk about present value, that means we have to discount the rental payments over a period of time, being the time of the lease. So what we're going to do is we're going to come up with the present value of minimum rental payments, and since our rental payments for our purposes are going to be on an annual basis, this will be the present value of an annuity, and it's going to be, the discount rate is going to be the lower of the lessor's implicit interest rate, the rate on the lease contract, or the lessee's incremental borrowing rate, the lesser of the two. Okay, to that then we're going to have to add either if BPO exists or guaranteed value components. And what that means is if the BPO exists, we need to include the present value of the BPO. If the BPO exists, then we ignore the guaranteed residual value and non-renewal penalty. On the other hand, if the BPO does not exist, we will need to consider if there's any guaranteed residual value or non-renewal penalty. Let's look at the BPO right now and just assume that it does exist. If the BPO exists, we will include the present value of the BPO. And the present value of the BPO payment at the end of the lease would be the present value of $1 in a future period. So we're going to discount our future liability or future payment by the interest rate, by the discount rate of, again, the lessor's implicit rate, the rate on the lease contract, or the lessee's incremental borrowing rate, just like we did for the present value of minimum rental payments. Now again, if the BPO doesn't exist, we need to consider whether or not there's a guaranteed residual value and a non-renewal penalty in the lease itself. And again, if we find that those exist, what we need to do is we need to calculate the present value of the guaranteed residual value plus any non-renewal penalty at the end of the lease. Again, the present value of $1 in a future period, and the discount rate is the same as the other discount rates, where it's the lessor's implicit interest rate, which is a rate on the lease contract, or the lessee's incremental borrowing rate. So that's how we calculate our initial lease liability. Now let's try an example in this case. At the beginning of year one, Zenez Corporation entered into a 3-year lease for a machine where the cost of the lease was $100,000 a year. This machine had an economic life of 4 years. The fair value / retail price of the machine was $250,000. The company could borrow funds at 12%, and the implicit interest rate included on the lease was 10%. Now, again, I'm going to show you the process you go through to determine whether it would be a capital or operating lease. And over here on the left, we see again the presence of any of the following attributes, these 4 attributes, in the lease agreement or any side agreement. If we say if any of these conditions are met, it becomes a capital lease. So the first one is provide for transfer of ownership. And in this case, if we read the problem text itself, there is no transfer of ownership implied. Contains a bargain purchase option, number 2, and again there is no indication of a BPO. Number 3, then, the lease term is for 75% or more of the leased asset's economic useful life. And in this case, the lease is for 3 years, economic useful life is for 4 years, so it's for 75% of the lease's economic life, useful life rather. So the lease term is for 75% of the leased asset's economic useful life. So this would be a yes or a check mark. And then that alone would make it a capital lease, but then we can go on and see the present value of the minimum lease payments are at least 90% of the fair value of the lease property at the inception of the lease. In this case, they are. So we'd also have a check mark for number 4. So in this case, this particular lease is obviously a capital lease. Now, if we want to calculate the initial measurement of this lease liability, we go and we start out with the present value of minimum rental payments. And again, that excludes any executory costs. In this case, the present value is we took $100,000 annual lease payments, $100,000 annual minimum rental payment, times 2.4869, and that is a discount rate at 10%. We picked the lower of the two. We we had an incremental borrowing rate of 10%, or the implicit interest rate was 10%. We picked the lower of the two. So the discount for the annuity over 3 years at 10% would be 2.4869. When we multiply that times $100,000, the present value of those three payments becomes $248,690. So that's the present value of the minimum rental payments. To that, then, we're going to add any bargain purchase option. In this case, there is no bargain purchase option, so that is going to be 0. Also, since there's no bargain purchase option, we're going to add in if there's any guaranteed residual value or non-renewal penalty. In this case, there is no such items in the text of the problem, so those would also be 0. So the present value of our minimum lease payments equals $248,690. When we record that, then it's going to be a debit to lease property for $248,690 and a credit to lease liability for $248,690. Okay, let's go on to the next slide and make this problem just a little bit more complex. Now, again, this is Zena's company again, and all the information in the top 4 lines is exactly the same. I've added a 5th line here, and it's in bold. It says Zena's was required to guarantee that the machine that they leased, could be sold for $50,000 at the end of the term of the lease. Now again, if you take a look at the criteria for capitalization, again, it meets criteria 3 and 4. But now I need to calculate the present value of my minimum lease payments. So I go back and I calculate, okay, what's the present value of my minimum rental payment excluding any executory costs? And I do know, again, from my previous slide, $100,000 minimum rental payment, annual payment over 3 years, when it's discounted at 10%, it's going to be $248,690, just like the previous slide. Okay, there is no mention that a BPO exists, so that is going to be not applicable, or 0. Since the BPO doesn't exist, now I look to see, does a guaranteed residual value or a non-renewal penalty exist? And in this case, what we find out is that Zena's was required to guarantee that the machine could be sold for $50,000 at the end of the term of the lease. So now we take that $50,000 guaranteed residual value and we discount it back to in effect what would be a final lease payment in year number 3 at 10%, and the discount factor in this case is 0.7513. So the $50,000 would be discounted back to $37,565. So in this case, then, the present value of our minimum rental payments is going to be $248,690 plus my guaranteed residual value of $37,565. So the present value of my minimum lease payments is $286,255. And again, I would create a debit to an asset called lease property, $286,255, and I'd record a corresponding liability on the balance sheet of $286,255. Now let's try a couple multiple choice questions regarding lease accounting for capital leases from the lessee standpoint. Number 1, a company intends to lease an asset. The asset qualifies as a capital lease, so there's not even a question. The lessee can borrow funds at 14%. The lessor's implicit interest rate is 11%, and that was computed by the lessee. The prime rate is currently 9%. The company will compute the present value of the minimum lease payments using, again, you're given your choices. Go ahead and stop your video. When you're ready, restart the video and view the answer slide. Okay, the answer to number 1 is the company will compute the present value of the minimum lease payments using, and the answer would be C, 11%. The discount rate to be used in the PV calculation is the lower of the lessor's implicit interest rate, which would be the 11%, or the lessee's incremental borrowing rate would have been the 12%. So that's the answer to number 1. Let's try question number 2. At the inception of a capital lease, the guaranteed residual value should be. Again, go ahead and you stop your video, and when you're ready, restart your video. Okay, at the inception of a capital lease, a guaranteed residual value would be A, included as part of the minimum lease payments at present value. Okay, let's try number 3. A company entered into a 9-year capital lease on a warehouse on December 31st of year number 10. The land and building are capitalized as a single unit. Lease payments of $52,000, which include real estate taxes of $2,000, are due annually. Beginning on December 31st, year 11, and on the same date thereafter, the company's incremental borrowing rate is 9% and prime rate is 6%. The rounded present value of an ordinary annuity for 9 years at 9% is 5.6, and at 6% is 6.8. What amount should the company report as a capitalized lease liability at December 31st, year number 10? So again, stop your video. When you're ready, restart the video and review your answer. Okay, number 3, the question again is, what amount should the company report as a capitalized lease liability at the end of December 31st, year number 10? And the answer in this case would be A, $280,000. And it's going to be basically our minimum rental payments is going to be it's actually $50,000 because we have to subtract out the $2,000 in taxes. So we take the $50,000 annual payment times the annuity times 5.6, and that comes out to $280,000. And that's the end of our video on accounting for capital leases, and at least the initial measurement from the lessee standpoint. And again, you would want to go on to the next suggested video, which would be leases, capital leases, and the lessee amortization of lease obligations. Thank you for your time.